Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. It's the 18th of July and this is our weekly webinar where we discuss the current movers in markets and the current drivers. We look at some of the key events and narratives driving markets and try to make sense of all of these moves, determining the main themes and stories. This week, we'll start with a look at how markets are shaping up currently to kick off Monday and the first day of this week, which is exceptionally busy with central bank meetings and some key data, not so much in the US, but elsewhere. It's a busy few days. We'll also look at US CPI and the sort of repercussions, ramifications of that report from last week. And then we'll look at and preview the main event for this week, which is obviously the Ecb meeting on this side of the pond. And also we'll look at some of the UK data, a big week for the UK and data. Obviously, a lot of politics going on as well, not so important as some of the data with the Bank of England meeting at the start of next month. Here's the disclaimer for you guys just to have a look at and browse through. Generally, it's quite an upbeat start really to the market after last week's better close on Friday. Obviously, we had that CPI data in the middle of last week, but then we had a couple of bits of data Friday, which sort of helped turn sentiment, and especially the buying in the dollar sort of slowed up, and this has actually come off again. DXY, which we'll look at shortly, the dollar modestly weaker. Hopefully you've had a look at the disclaimer now. Before I check out last week's data, as I say, just worth having a look at today, obviously, US equity futures really trading higher overnight following last week's real roller coaster, really, with gains supported by that softer dollar, in fact, and stronger Asian markets. Chinese regulators, I think, and its central bank offered more support with a funding crunch across the property sector. And fresh COVID cases, of course, posing risks to the Chinese economy. Commodities, they're generally trading higher as a result, with oil receiving a bid after President Biden, as expected, left the Middle East with no promise of extra barrels. Another reason for the dollar losing momentum is that investors have taken a more guarded approach really to next week's Fed meeting and have almost fully priced out now that prospect of the jumbo 100 basis point Fed hike in July. That was really sort of got the market excited after the US CPI print, which we'll look at, above 9%, shocked most. And obviously fixed income markets, money markets started pricing in heavily a massive 100 basis point rate hike last week. That has now abated. For sure, the FOMC will still debate probably potentially a bigger move, as well as the 75 basis points which are priced in. However, especially late last week, we saw several Fed governors, Bostic, George, plus notably two of the most hawkish FOMC members, so Bullard and Waller. They suggested that the bar for a 1% hike was very high, really, and that their base case was still a 75 basis point move. I mentioned Friday's data. Worth just having a quick recap on that. It probably wasn't enough for markets to really embrace the idea of that jumbo-sized rate hike. Retail sales, US retail sales, they were pretty solid. The headline figure, the Empire Manufacturing Survey, unexpectedly improved as well. But still, forward-looking indicators, they point to difficult times ahead. And importantly, I think the focus for the markets, unusually, but as we said last week, Fed Chair Powell has said that the University of Michigan survey and inflation expectations they looked at, and these eased. So these eased on Friday to 5.2% from 5.3%. I think 2.8% for 3.1 for the 1 year. So really, I think if you look at price action on Friday, markets did move. The dollar did sell off on that easing of inflation expectations in that University of Michigan sentiment survey. Really, then markets concluded, yeah, that whole mix probably not enough to deliver another hawkish surprise. This week, we're thinner on the ground as far as US data is concerned. No, this is key as well, really. No FOMC comments, as Fed members are now in a blackout period ahead of the July 27 meeting next week. So really, it kind of seems doubtful that between now and then, markets will probably seriously be unable to reconsider that 100 basis point increase. There is some focus on some housing data, which is expected to continue feeling the pressure from higher mortgage rates. But really second tier data from the US out this week. Regarding the dollar then, we've got the DXY chart there. The 75 basis point call for July, that's pretty nailed on. We'll have a look at that on the CME Fed Watch tool soon. But that call probably should put a floor under the dollar in the near term. Obviously, we've sold off Friday, sold off today as well. But really, we're expecting the large majority of dollar moves this week to be linked more so to swings in global risk sentiment, which is probably driven by non-US developments. There's probably three things to look out for the oil market swings. They continue to be watched quite closely. Brent attempting to hold above the $100 mark, quite a sort of psychological mark there, level for Brent crude. And that's amid rising demand concerns. We probably have to look at the OPEC Plus meeting at the start of August the 3rd, really, which is expected to be potentially quite volatile. Second reason underpinning dollar strength, COVID cases still there, still rising worldwide, really, as pretty much highly contagious variants are still seeming to be spread quite rapidly. China's situation is obviously key. That stabilized over the weekend, but the risks certainly of fresh lockdowns in China, they do remain a driver, of course, of these fears of a global recession. Finally, really, concerns there are, we've said it before, this Russian gas supply concerns remain elevated. The Nord Stream maintenance, that finishes this Thursday. So, around the 21st, it'll be key to see what Russia does, whether they have a rethink on how much gas they are turning on that Nord Stream pipeline, really. That will be a key focus for Thursday. Obviously, we also get the Ecb meeting. And we've just had this sort of situation in Italy as well with its government, just adding another element of risk for Euro assets and European assets. I think the latest is that the government may be able to pass or get a vote through, and Draghi will continue. But that is obviously some source of uncertainty for Europe, especially, and the ECB, which we'll explain shortly. As I said, focus on Thursday, ECB, their first rate hike since 2011. As far as the DXY is concerned, the dollar, we can see just on the weekly, always like to show this strong uptrend, of course, since the start of the year, really. Higher highs, higher lows, even strong bullish channel. The 103.82 we hung around for, then that acted as support and we pushed higher. And then sort of that candlestick last week obviously printed those highs. Multi-decade highs, really. 109.29 we got to, so didn't get as far as I think we pointed out. 109.77 was the September 02 high, so not as far as that. We were overbought, of course, on the weekly, also on the monthly that we've pointed out. And that sort of candle, not quite a shooting star, so not quite a classic bearish candlestick, really. Shooting star really having sort of long upper shadow that we can see, but then little or no lower shadow and a small sort of real body, near the day's low, so we didn't quite get that, but sort of ominous signal that the buyers couldn't hold above sort of near its highs at least. And obviously we've sold off today and later, sorry, on Friday as well, and then today. 103.82 key support, probably support there from that 13th of June high as well, around 105.78. If we do get that low, probably last week's low initial support, then 106.89. That's on the DXY. Much to do with the euro dollar, of course, high weighting, the strongest weighting by far, the biggest weighting by far in the DXY. So much will depend on euro dollar on Thursday for sure. Just looking at the other risk market we always like to look at, the S&P, the S&P 500. Bear with me 1 second. You can probably see I've got the futures up there, but as well, let me just take some of these off. So yeah, this is, the daily chart. I'll take the counter channels off for ease. Obviously that downtrend, that bearish channel really from those March highs again, series of lower highs and then lower lows, got to the bottom of the channel quite neatly actually a few times here, and then we've bounced pretty much. And you can see the sort of sideways choppy price action over the last few weeks. We're now trading, actually, interestingly, we're trading above that mid-May high at 3810. And also I've got this dotted line in here. If we just go to the weekly, we can see that's a fib level, prominent fib level, going back from the March pandemic lows to the all-time high there. The midpoint we didn't get to at all, around the 3,500 mark we've highlighted before. Then the 38.2 retracement from that high, 38.15. 38.10, 38.15 then was a sort of zone, which we're now trading above. So interesting there for Monday. We're trading above there. Obviously, next levels on the upside, the light blue line, 50-day moving average, 39.36, sort of tallies with these highs here, sort of intermittent highs. July 8 high, 39.18, and then this high towards the end of June at 39.45. So again, a sort of zone of sort of initial resistance if we can get towards those levels. And then beyond there, we get the top of the channel and then the 4,000 psychological level for sure. But it looks like we're sort of choppy trading really for the meantime, until probably we get the Fed meeting potentially. I think it's worth quickly looking at last week's main risk event, the US CPI data. Mentioned it quite a few times. And really, yeah, consumer prices, they rose across most goods and services again in June at a speed that pushed the annual increase to 9.1%. That was the biggest jump since November 1981. The advance really surpassed even the most aggressive forecast by economists, with consensus being an increase of 8.8%. And really was another unwelcome development for the Fed. That is obviously it's emphasized its unconditional commitment to tackling high prices. And that comes even at the expense of the economic recovery. On a monthly basis, prices jumped, I think, another 1.3% in June. That followed a 1% rise in May. And once we strip out volatile items such as food and energy, that's core inflation, then that increased 0.7% compared with May's 0.6% advance. And that translated in a core reading on an annual basis to 5.9%, roughly in line with the 6% pace reported the month earlier, and slightly above estimates. But really it's the issue that the monthly inflation gains, they're still broad-based, according to the BLS. What are these sort of broad-based increases? We've got here the chart we've shown you before. Rental inflation is key. Other increases, you had the energy index that contributed almost half of the jump in the headline inflation rate. Petrol prices rose 11.2% in June. Food prices were up New and used vehicle prices, they continue to rise. And services inflation, so excluding energy, that climbed as well, I think 0.7% on a monthly basis. And that was up 5.5% compared with the same time last year. But just on this chart, so shelter-related costs, they drove a significant portion of the increase, 5.6% year on year, I think 0.6% on the month. That's the biggest annual increase since February 91. A kind of broken record, just pulling out dates from decades ago as another new high, but obviously significant. And this chart, so a 36-year high for rental inflation, shelter, so that accounts for a third of the total of the CPI weighting in its basket. So really key, and that's why we sort of focus on it. It's a serious issue which really can only be fought by tighter monetary policy. And really, when you look at all those details of broad-based increases in monthly inflation, especially, then obviously the Fed is having to act. And the detail really is sort of worse than you can, worse than you sort of imagine when you do go down and dig deeper. Let's now get to the main event of the week. That is the ECB meeting for sure. If we just pull up the euro-dollar chart firstly, but yeah, just on the ECB meeting. So President Lagarde and the Government Council, over to them really on Thursday. Markets really fully expect a first rate hike in 11 years. That should be probably the least surprising part of the ECB meeting, as it's been indicated by many of the ECB officials over the last few months, in fact. So I think markets are pricing in actually. So consensus sees a 25 basis point hike, but markets are actually pricing in around a 30% chance of a bigger 50 basis point move. And assuming the ECB does indeed raise rates just by 0.25%, 25 basis points that is, then the focus of the meeting will be on the ECB's updated guidance for future meetings, particularly September, where some officials have signposted a 50 basis point move there. And we'll also get the probable announcement of some detail on the anti-fragmentation tool. And that's designed to limit sovereign spreads, the divergence of sovereign spreads, and improve monetary policy transmission. Certainly the challenge for the ECB is to turn the policy screws in the region, if you like, without squeezing its more heavily indebted economies like Greece and Italy. And the anti-fragmentation tool, that is aimed at, as I say, limiting the divergence in borrowing costs between the bloc's strongest, essentially, and their weakest economies. And the key issue in there, I think we've touched on it once before, actually, is the gap between, we'll look at it here, between Italian benchmark bond yields and German benchmark bond yields. And this chart actually, not this chart, one second. The chart here is actually that difference. So not trying to get too technical, but you know, a lot of people, you know, in the markets talk about this, the yield spreads and the divergences, sorry, between different countries. And that's what we're talking about with this anti-fragmentation tool. So trying to limit the difference between, say, and this is a chart showing the spread. So all it is the spread between the Italian benchmark 10-year government bond and the German 10-year government bond, the difference in those yields. And you can see actually that we came off, we were sort of obviously moving higher around the 2.5% mark. We obviously came off rapidly. I think that was on the day of that emergency call by the ECB, where they said they would definitely address this issue. 2% sort of marker there tacked in as sort of unofficial line of where spreads should go, or these spreads shouldn't widen beyond that. Obviously, we moved down, in fact, but then towards ECB, people getting nervous, and in fact, we jumped to the highest levels in over a month in these in this yield spread between Italy and German 10-year government bonds. Don't want to get too technical, but it just sort of highlights the issues that the ECB is really facing. And I think most ECB watchers, they expect a mechanism without limits that will be deployed tactically to smooth these market trends. The hope is that the threat of intervention is credible enough, of course, and therefore that would minimize interventions and really avoid one-way bets, which could result in the loss really of market access. Some economists are not expecting a lot of detail. So from the ECB regarding this tool, and they certainly don't expect any sort of targeted spread or yield levels. So again, not trying to be too technical, but really a source of volatility potentially during the meeting and before the meeting after that rate decision. That rate decision comes at 12:45 UK time, and then you get the press conference at 1:30 UK time. So if they do announce, obviously expected to announce the rate hike, 25 or potentially 50, some volatility there. But also then if we get some detail even around the fragmentation tool, anti-fragmentation tool, and sort of detail, some not expecting a lot, and then others, market watchers really expecting quite a lot for the policy, the mechanism to be quite bold. So again, a source of volatility potentially at 12:45 when they announce, and if they have a statement around that tool, or then at 1:30 for sure at the press conference with President Lagarde. As I say, a 25 basis point rate hike is more likely really than a 50 basis point move. Probably not only because the Governing Council, the ECB Governing Council, is strongly guided to that decision in the last few weeks, of course, but also because the growth outlook has weakened sharply. And the ECB, just going back, the growth outlook has weakened sharply, and especially we have this Nord Stream issue, which has obviously spooked markets quite a lot. We got euro dollar through parity, which I'll talk about in a minute. So yes, growth really has impacted more recently. And also the ECB, like many central banks actually, has historically really not delivered a hike when we're less than 70% discounted. As I said, there's around a 30% chance, I think, of a 50 basis point move on Thursday. So really expectations are for just that 25 basis point rate hike. As far as euro dollar goes, I'll just pull up the chart here that we had. So obviously parity was huge. We broke down through there on Thursday, 99.52 the low. Big level, grabbed all the headlines, but then obviously we've made our way back above one. And actually, as we pointed out, yeah, we were oversold on the daily. Also on the monthly, you can see there. And I think we were oversold, yeah, pretty much on the weekly, on the monthly, the weekly as well. So really due a bounce back. That's what we've seen. Parity holding up then for now. That oversold, we were pretty much in that territory for most of the week, and that has probably kept us supported and prevented a sustained drop below one. Near-term resistance is probably, well, around here, look, 102 level, just below there. I think we've got the 20-day SMA, the 20-day simple moving average around 102.57, and then obviously that 103.41 level, the pandemic low from 2020, if we could get that high. But obviously long term, the trend is for lower prices, and expectations are this is probably something to sell into this rally, as they have been rallies over the last few months. Let's next touch on sterling. Big week for GBP and Bank of England expectations, really a number of key reports. I think I've said it before, but we do have specific weeks in the month, normally, yeah, towards the middle of the month when we get 2 to 3 really big data releases, data dump from the UK. We've got the labour market data on Tuesday, inflation data, both consumer and producer on Wednesday, and we get 2 lots of house price data as well as consumer confidence and official retail sales, as well as the flash PMIs. In fact, this will be the last readings on all of these data before the bank's 4th of August meeting. So critical week for GBP, really. Just touching on the 2, probably the main releases, the jobs report in the UK out Tuesday, as I said. Recent official and survey data really suggests the labour market is showing signs of slowing. Still tight, of course, but potentially signs of some small showing. The focal points in this release will be the unemployment rate, expected to rise to 3.9%. Vacancies, they reached a peak of 1.3 million in April. But some weekly surveys do suggest we've passed the peak. We'll have payroll jobs, which are expected to post a small rise. And then we have wage growth as well, where the headline rate is really expected to remain pretty much close to current levels at this point in time. And the release on Tuesday. Then we get the CPI data on Wednesday, expecting a further rise from 9.1% in May to 9.3% in June. Most economists, they assume another rise in food prices similar to recent months, while petrol prices have risen by over 8% during the month. So definitely going to give a boost to CPI. Most economists, I think, expect inflation to rise into double digits in the autumn as the price cap for energy prices, the Ofgem, raises that cap in October. I think the Bank of England sees inflation reaching a peak actually of around 11% before the end of the year. Regarding the Bank of England, then the consensus call is for a 25 basis point hike, but the risks are certainly increasing for a larger rise. Markets, I think they're pricing around actually 42 basis points of hikes or of a hike in August. So that's nearer that 50 basis point hike, really. And then they're also pricing in 2 more 50 basis point hikes at the bank's subsequent meetings. So you kind of think this data this week will offer probably moderate support to sterling, to GBP. And we also note that Governor Bailey, the Bank of England governor, he speaks tomorrow as well. So watch out for that, which will be after the labour market report. Certainly global risk sentiment is a big driver for sterling as well, and for cable. And probably then we saw the lows, as I said, last week, that low in cable, 117.59 actually. And similar to the euro, buyers stepped in around the 118 level there, pushed us higher. The figure area, well, that looks like acting as a floor now. So the 118 figure, really potentially a floor for now. We tried a few times, as you can see, over the last week to push below there. Only once really with that low, 117.59. The broad trend, again, similarly, long-term trend points to an eventual drift. We probably think lower again, and we'll try and attack the 118 level. But in the meantime, in the short term, probably resistance points to, well, today we're getting above that mid-June high, 119.33. So that's an important level, really, we think. And above here, again, sort of medium-term high from the 8th of July, 120.56. And then that cycle low there from mid-May, again, 121.55. So a couple of levels of resistance to watch out for, and potentially looking to sell into that rally, into those rallies above there, with a view to the long-term trend asserting itself again. I think that's about it for what we want to cover today. Hope you've enjoyed the webinar, and as I say, we're weekly every Monday, midday London time. Follow us on social media, of course. Also read our daily commentary on the website, and have a good week's trading and good luck out there.